Welcome back to WealthWire India. Today, we're jumping right into a premium explainer covering one of the most unprecedented, frankly mind-boggling financial events of the year. We are talking about the sudden appeal to just halt physical gold purchases. And this is in the world's second largest gold-consuming nation. For generations, gold has been our ultimate emotional, cultural, and financial safe haven. So what actually happens when an entire country is asked to just stop buying it? Let's get into it. We must resolve not to purchase gold for a year, no matter how many functions we have at home. That highly unusual, very direct appeal from Prime Minister Narendra Modi has obviously sparked a massive debate across households and financial markets. But we really need to frame this correctly right out of the gate. This is not a legal ban. Actually, scratch that. It's more of an urgent, calculated request driven by some incredibly severe macroeconomic pressures.
Okay. Let's dive into a roadmap for this explainer. We're going to cover the call for economic patriotism, break down the macroeconomic tug-of-war, and analyze the market impact. Then we'll lay out a digital gold roadmap for your portfolio and wrap up with the long-term bullish predictions.
Section 1. The call for economic patriotism. The absolute most crucial thing to understand here is that this is a voluntary pause. It's a call for national resilience. There is literally zero reason to panic. There are no limits, no actual restrictions, and for sure, no legal penalties for buying gold right now. You're completely free to buy jewelry or bullion. Instead, what the government is doing is making a strategic, patriotic ask. They're hoping citizens will voluntarily hold off on discretionary purchases just to have the country weather a very specific but temporary global storm. And that brings us to this really fascinating concept people are calling economic patriotism. Neutrally speaking, the whole goal here is just to align our personal spending habits with the nation's economic resilience. Think of it like this. Physical gold doesn't immediately fuel domestic industry the same way importing, say, oil or heavy machinery does, right? That's why economists sometimes label it a non-productive import. So the aim is to just temporarily shift our household savings away from these imported physical assets to keep our foreign exchange reserves locked down during a time of crazy global volatility. Section 2. The macroeconomic tug-of-war. So what's actually triggering all of this? Well, it's crude oil. Thanks to escalating geopolitical tensions in West Asia and the effective closure of the Strait of Hormuz, global crude oil prices have absolutely skyrocketed to a staggering $126 per barrel. And since India imports roughly 85% of its crude oil, this creates an enormous, immediate demand for US dollars just to pay that massive fuel bill. Now, sitting right next to that soaring oil bill is this jaw-dropping number, $72 billion. That is the size of India's annual gold import bill. Because India produces very little of its own gold, almost all of that 700 to 800 tons of annual demand, which, to put that into perspective, is literally airplane loads of gold, has to be imported. So importing incredibly expensive oil and massive amounts of gold at the exact same time acts as a severe double drain on the country's foreign exchange reserves. Let's break down how this builds into a really vicious macroeconomic cycle. Step 1. Geopolitics cause oil prices to surge. Step 2. India's demand for US dollars spikes to pay for that oil, and, of course, to pay for imported gold. Step 3. All that selling of our domestic currency to buy dollars directly weakens the Indian rupee. And step 4, because the rupee is now weaker, importing that exact same oil and gold suddenly becomes even more expensive. It's a dangerous loop that just keeps straining the national economy. Pausing the gold buying temporarily breaks that loop.
Moving on to Section 3, analyzing the market impact.
Looking at the latest data from the World Gold Council, it's pretty clear that while the news definitely caused some immediate turbulence, pulling prices back just a bit from their all-time highs, the underlying value of gold is holding its ground incredibly well. The domestic price momentum might have cooled off for a second, but the structural resilience of the asset remains super strong.
Now, here is where things get really interesting. We're seeing this massive, ironic split between the global and domestic markets. Since India usually consumes about 20 to 25% of the world's gold, a sudden pause here could actually create a global surplus, which might lead to major price corrections internationally. But inside India, it's the exact opposite. Lower official imports create a really tight local supply squeeze, which means domestic buyers could actually end up paying high premiums. Some are already crossing $20 per ounce just to get their hands on whatever physical gold is currently available.
The immediate fallout from the announcement was fast. Discretionary buying for upcoming festivals basically hit a wall. Financial markets kind of panicked, hitting major jewelry stocks hard. Companies like Titan, Kalyan Jewelers, and Senco Gold dropped by up to 9% in intraday deals. And right now, importers and jewelers are facing a huge wave of uncertainty about their near-term supply chains. So yeah, your local jeweler might have less stock and probably higher making charges right now.
Section 4, the Digital Gold Roadmap. The absolutely crucial takeaway here is that the government is not against you investing in gold, not at all. They just want you to do it a little differently. They're actively encouraging a shift to policy-friendly digital alternatives. These formats give you the exact same financial exposure to the price of gold, but because they mostly just recycle existing domestic gold, they don't drain our national foreign exchange reserves by importing fresh physical bars. So, here is a very clear 3-step playbook for retail investors right now. Step 1. Hold your current physical holdings. All the experts agree that panic selling your physical gold right now would be a huge mistake. Step 2. Shift your new, fresh investments into gold ETFs. And Step 3. If you're looking for long-term, tactical exposure, look at buying existing sovereign gold bonds in the secondary market. Sandy Brightura over at PL Capital hit the nail on the head. He noted, gold ETFs and electronic gold receipts continue to remain policy-friendly as they help recycle domestic gold instead of driving fresh imports. By using paper and digital gold, you are doing two things. You're protecting your wealth and capturing the upside of the gold market while actively supporting the national economy at the exact same time. Win-win. Section 5, Long-Term Bullish Predictions. Just take a look at these massive 2026 and 2027 price targets coming from global banking giants. Goldman Sachs is targeting $5,400 an ounce. That translates to roughly 1.7 to 1.9 lakh rupees per 10 grams here in India. JP Morgan is even more aggressive, projecting $6,300 an ounce, pushing the Indian equivalent well past the 2 lakh mark. What this tells us is that despite these temporary domestic policy pauses, the long-term global outlook remains just incredibly bullish. And when we examine the technical upward trends in gold ETFs, we can visually confirm that the structural bull trend is firmly intact. Honestly, any near-term volatility or consolidation we see right now is largely being viewed by market experts as a buying opportunity, definitely not the end of the rally. That bullishness is built on some massive global factors that are operating completely independently of Indian domestic policy. We're talking record levels of physical buying by global central banks. There's a broader macroeconomic push for de-dollarization happening worldwide. Add in expectations of further interest rate cuts from the U.S. Federal Reserve and rising concerns over global debt. All of these factors combined act as a solid structural floor, practically guaranteeing gold prices are pushed higher. Which brings us to the ultimate question we want to leave you with today. In light of all this macroeconomic data, how are you going to balance your deep-rooted cultural traditions with this new call for economic patriotism, all while optimizing your modern portfolio strategy? Thanks so much for joining us for this explainer. We'll catch you next time as we continue to unpack the forces shaping your wealth.